All right, so this is like 401ks, and it's crazy because like most people think that 401ks are the bomb diggity, which hey, in some cases they are. Um, but I've got this here that I want to share with everybody, and I might have said it before, but when it comes to like a 401k, the crazy thing, and I can't wait for Gerard to show you guys, is just that when it comes to 401k, there's a certain amount of money that you can put into your 401k per year. And in 2024, that amount is $23,000 a year. All right, so that's total contributions. That's if you as the employee put in, and then also your employer, total contributions per year. Now, like speaking of, we were talking about younger people. Let's say that you are 25 years old and you maximally fund your 401k. You put in a full 20 or $23,000 per year up until you're 65 years old, right? At that point, let's just say, and we're gonna predict we're gonna predict that the market does not, or that the accounts that your money is in does not grow, it does not drop. At that point, where is my calculator? You got 40 years of putting in $23,000, which sounds absolutely amazing, right? Now, obviously, you can predict that the market to go up, be down. Right now, I think on average they're around 6 to 8%, Gerard, for
I would say
401ks
somewhere in
maybe.
that range. Yeah.
I think six to 8%ish. But that also, that's not per year. That's maybe it's on average, kind of, right. A lot of things, but let's just say that that's all. We have a total of $920,000 in that account. All right. By that point, just from all the money you put in, if we're only predicting that. And the cool thing, and this is something that I know Gerard's going to teach you guys about, because I'm sure he's very aware of it, is the safe withdrawal rate. The safe withdrawal rate means that you can take out 4% per year from your retirement account without running out of money before you pass away. So if I take out 4% of what I have, whatever I actually have, because this might be a lot less, might be more, this is going to be times 0.04. I can take out $36,800 per year in retirement, which, I mean, for some people, this is not a bad number. That's not a bad number. This is like, okay, you can be able to take a few trips per year, and like, that's about it. However, then you think of taxes, and then you think of also your inflation and how much this will actually worth at that point in time. And then also think about the fact that over the course of that time, your money was doing this, right?
There's a couple other factors too. When you go to retire, you
Mm-hmm.
lose some write-offs. Like if your house is paid off,
Yep.
you're not contributing to your 401k anymore, so you lose some deductions as well.
Yep. Not contributing. Then also you've got so many different things. And that's just 401k. IRAs, Gerard, IRAs, what is it? The max that you can put into an IRA is
7,000.
7,000 this year, right?
Yeah. And you can do it if you're 50 or older. You can put in an extra 1,000. They call it a catch-up.
50 plus 8. And this is if you took all of the money and you put as much in as possible, and you started 20. Gerard, imagine somebody saying, yep, I'm going to start retiring now, and I'm 35 years old. I'm going to just put everything I got into my 401k. Whew. Yeah, it's not even going to be worth. It's probably barely going to be worth what it is today. But I want to share that with you guys because what I think Gerard is going to show you here is how do you start to think and open up your mind to different options out there for retirement planning and the types of things that you can ultimately do. I'm sure he has an example. He's going to teach you guys as well, just like I love to teach you guys with some really nice graphics as well. But Gerard, if you be so kind to be able to share why specifically matching a 401k to an IRA to other strategies like indexing strategies, like I talked before, are so important to be able to see.
Yeah, let me do that. And one thing I wanted to share real quick was
Go ahead.
share screen. I think the pictures. Okay, let me just get rid of that. So there's different buckets. Let's just call it buckets. And
Mm-hmm.
so it's important to understand that you want to be able to diversify and put your money in different places. There's tax now, which is your bank account, CD, money market, and brokerage, and that's money that we've already paid tax on, right? You got paid from your paycheck, you paid tax on it, and then when you put in your bank account, the CD, the money market, the brokerage account, whatever interest that grows, we pay tax on it again. And then you have tax deferred, which is your qualified accounts, which is anything that you've put in pre tax. So your IRA, your 401k, your TSP, 403b, your pension. Those are tax deferred. So you don't pay tax now. At some point, you pay tax in the future. So, for example, let's say that you worked for a company for 30 years and you put in 200,000 on your 401k or one of those qualified accounts over that time, and it grew to $1 million when you go to retire. Well, the problem is now you're going to get taxed on that million because the government didn't want to tax you at the 200,000. They
Mm-hmm.
wanted to tax you at the 1 million. And the problem I've seen sometimes when people have done financially well and maybe they didn't need the money, they wanted to save it for a legacy for like their kids, their grandchildren. There's a thing called RMDs, or required minimum distributions. The government forces them, whether they want to or need the money, forces them to take that out. And the end result is sometimes, excuse me, they end up in a higher tax bracket, pay more taxes, and they're depleting their retirement account. And then the last bucket is the tax advantage, like the Roth IRA, the cash value life insurance. And so there's three different buckets here we want to make sure that we're diversifying in. And so, you know, this is a smart strategy to be able to do that and not just putting all your money in the market like the 401k. So I'm a visual person, so I start
Mm-hmm.
this way with clients and show them the difference of what I call the status quo, which is an IRA or 401k, one of those accounts, versus an IUL. And so there's really three things that we can control during our retirement: where you save it, how much you save it, or how much you save, and when you retire. And actually, I should, after talking to Charming now, I should add in there, how long you save, because that's important too.
Yep.
So the problems and the risks with the status quo is unnecessary taxes. And if you're not aware, in the last 80 years, besides 2 years or 3 years in the 80s, our tax brackets federally are at the lowest point they've been in 80
Yep.
years. So, and I'll talk about that a little bit in a minute. But there's problems with the status quo, which is the IRA, 401k, TSP. We have unnecessary taxes. We have risk of market losses, and then even maybe not having enough for retirement or outliving your income. And so we all want the same thing. We want more income. We want to pay little taxes as possible. Most of us who are aware, we want to avoid that roller coaster ride. And we want peace of mind so we can sleep at night. And I always ask people, what do you think the average stock market return is? I let them guess. And,
Did I
you'll
give
be
this answer
down to,
away?
oh, sorry, what was that?
Did I give this answer away?
I don't know. What did you say?
Did I give this answer away early when I was talking about
Uh,
the 401k?
well, you were in the market, so you
Okay.
were right there. So I added this slide in. You didn't see this one, Charming, but the reality is it's about 5.89. Is if you look over the years from 2000 down to 2002, the red is the 7 years where the market had a negative return, and the green is 5 years where it had over a 20% return. But this is called a sequence of returns. And so it's very important because if you retire in a year that's especially a down market, like if you retired here in 2008, like other people did, and you lost 40% of your money right here, and you're pulling money out, that's like a double negative. And
Yeah.
so the average rate of return I don't, I have to take this out. That's including fees, average 1.25 to 1.5 of brokerage fees. Because when you have these qualified accounts, there's people paid to manage this. They're not really managing it, but they're paid to do it. So 5.89%. And then Charmy talked about this. This is standard in the industry. Safe withdrawal rate is 4%, so you don't run out of money. Now, in the IUL and something like that, you can take out more, and the reason is because you don't have to contend with losses, where in the market you do. And as I mentioned in our history of our tax rates, right here, 1945, we were over 90%. That was our
That's
tax rate. And look,
crazy.
that went all the way here to early 60s. So from 45 to 60s, our highest federal tax break bracket was over 90%. That red line you see, that's where we are today. 37% is our highest federal tax bracket. And if you look, and
Jeez.
if that was an iceberg, there's a lot of that iceberg above the red versus below, meaning that we're at a low point in taxes right now. And so I show them, if you were putting in 12,000 a year into your retirement, and you had 25 years to save, and the average return rate was 5.89%. But I actually stepped it up and said, okay, let's do best case scenario. So the only thing I changed here is I added in the company match. So let's say your company was matching, half. So they put in 6,000. Now you're
Hmm.
putting in 18,000 a year over 25 years. And so when I go to investor.gov, so we put in, and I can show you here, we can put in the numbers right here. Monthly contribution, so 18,000 is 1,500 a month, 25 years. And I do this right in front of them.
Ooh, Gerard, are you
5.89.
showing? Are you on investor.gov right now?
Yeah, you can't see it?
No, sir. You want to go ahead and just switch over?
I don't know how to do that. So,
You should be able to come back down to share screen and
I
stop
got to
sharing.
share a new screen.
Yes. Yep.
All right, let's see. Oops. Yeah, I'm not too good with this sharing stuff. So,
It's all right.
all right, let's see.
I got to do it all the time, and I get uber confused.
Okay. Normally, when I just click on my tabs, it changes. So, okay, so
Yeah.
we have zero initial investment, 1,500 a month, which is 18,000 a year. 25 years, 5.89, and I just put a zero, and then I calculate, and it tells you right here 972,397 right there. So I actually take a copy, a snapshot of this, and so let me go back.
Yes.
Are you seeing back to the presentation?
Oh, you're gonna have to reshare.
All right. Oops, how
I
do
think here
I?
on Google Chrome, there's like you have to like click over to screen in order to just go back and forth, and let's just share the screen. But it's all right.
Yeah, it's not. Let's see. Stop sharing. Let me go back to. I'm not. Oh, okay. Hold on. There we go. I got to go back to. Sorry, I
Oh,
had to
you're
go
good. It's
back
okay.
to this main page here. So, all right. So let me go back.
It is all
Sorry.
right.
Okay.
That's how we do.
So we're back, right?
Yep.
All right. And as you can see, 972,397. So I do this right in front of them. I did it in advance to have it on here, but I go and live and show them so they can see. So if we take that 972,397 and we use the safe withdrawal rate, why? Because that's what the industry standard is, and that comes out to a pre-tax income per year of just about 39,000. And so I used the effective tax rate. I just added in 20% for effective
Mhm.
tax rate. That's not even including a state tax if you live in a state that has tax. Now, I live in Las Vegas in Nevada, We don't have state tax, but so anyway, I didn't include it.
So
Twenty
move to
percent.
Nevada.
We take the 20% out, and so that leaves you with a yearly income of 31,000. Now, keep in mind, this is 25 years in the future. That 31,000 is not a lot to live off of today. In the future, it's going to be even less. So I show them how much do you need in retirement. Is this enough income for your dreams, your goals? Go traveling, put kids in college, have no debts, pay off your house, weddings, all these things that come. So most people aren't aware of this. Who gets paid before you're on your 401k before you do? The mutual fund company or target date fund gets paid. The plan
Wow.
manager gets paid. The sales rep gets paid. The IRS gets paid, and then you. So let's look at a better alternative. And by the way, if you guys are football fans, Jim Harbaugh from the University of Michigan, head coach in 2016, was the highest paid coach in history with the IUL product. And so it shows his name here. It shows here the insurance wrapper, which is the IUL. And then under this split dollar agreement, so University of Michigan paid $2 million 7 times into this life
Jeez.
insurance policy for him. And the end result is at age 66, he could start taking out 1.4 million a year tax free. That is awesome.
Wow. Yeah.
And I think they've been trying to recruit him for a long time. I think he just got recruited into I know his brother is coach for the pros, but I think he's going to be coaching San Diego now. But he still has this plan because it's paid.
Mm-hmm.
And so it just talks about the bottom one. It's risk free. So we've got, I wouldn't exactly call him an ordinary person, but he's got an IUL, which is, it's a great product. A lot of different things wrapped up in, the IRC 7702 tax code. It's got guarantees, it's tax free, and it's risk free. By the way, everyone recognizes these names. Ray Kroc,
Mm-hmm.
when he started McDonald's, he pulled cash out of his cash value life insurance to start McDonald's. Now, same concept, different product at the time, but same concept. Walt Disney, if you've ever heard the story of him, he went around to like hundreds of people to get to invest with him in Disney World. He pulled cash out of his life insurance policy to start Disney. And J.C. Penney is famous for pulling cash out of his life insurance policy during the Great Depression to actually fund the company and employees' paychecks.
Mm-hmm.
So when we look at the best case scenario, and I didn't even include fees or losses in there, which is obviously unrealistic, but best case scenario, or when we do end up putting the same amount of money and everything into the IUL. As a matter of fact, there was no company match, so I only put in 12,000 into the IUL. Same parameters, everything. That person would be able, instead of taking 31,000 a year, they would be able to get approximately 115,000 a year. That is a 272% increase. And there's also a death benefit that would pass on tax free to their heirs as a legacy. And so I go into these steps and I just show them the last few slides here. I always tell them, okay, this is just your information. These are the indexes that we invested in, and I just diversified here. So for the following slides, just ignore this because this will stay the same. So you have a person, this is year one and their corresponding age. They're putting in 1,000 a month. So keep in mind, there's no company match here. They're not putting in 18,000. They're putting in 12.
Yeah.
Their death benefits rising slightly. Okay, so we just fast forward. Oh, I just show them this. Just ignore that, and then ignore that. We don't follow this because that would be if you use more of the fixed. We never use the fixed in this product.
Yep.
So we go on down to year 20. They put in 240,000, But look at where the cash values grow in here: 386,000. Death benefits 526,000. And then I show them at age 65, they stopped paying. So they put in $300,000 over those 25 years. Look at where the cash value is, almost 590,000. The death benefit is up to 719, and now they're able to pull these what we call policy loans, which they don't have to pay back, 115,000 a year, tax free. And keep in mind, while they're doing this, this policy has living benefits, chronic, critical, and terminal illness, which can be used in case of, major illness, heart attack, stroke, cancer. They go into a rest home. They can use the cash out of this to pull out to help with that. So the end result is here at 80 years old, they've put in 300,000. They've pulled out 1.7 million in tax-free money.
Yeah.
Now the death benefit's going down, as you can see. The cash is still accumulating, but I think this is the last slide here. Yeah, I read it to age 90. So again, they only put in 300,000 in the green box here. Now they pulled out 2.8 million. And there is one more slide. And finally, if they live to age 95, again, they've only put in 300,000 because they stopped paying at age 65. They were able to pull out $3.4 million over the course of those years, and the death benefit was 1.486 million. And so this is why this is so important to understand that there's different products out there. We always recommend. You can see me now, right?
Yep.
Stop sharing. Okay. This is why it's so important that we make sure that people understand these three buckets. Put money in the taxed for just your emergency money. You want to make sure you have at the maximum 6 months in there. If you have an IRA, 401k, a pension, put in up to what your company is matching.
Okay.
And then we'll use the rest of that money. You could put some in a Roth 401k if you want, or I'm sorry, Roth IRA. And then we'll put because you're only limited with the Roth. You can only put in, as Charming said, 7,000 a year. Now, a lot of these IUL policies you can put in significantly higher. We can design them that you can put in a lot more money, and they're just great policies. And so, by adding the IUL strategy to your portfolio, you have a death benefit from day one. You've got tax-free growth, tax-free income, policy loans that you can pay back or you don't have to pay back. You've got living benefits, the chronic, critical, and terminal. No IRS rules against withdrawals and penalties. So if you're not quite 59 and a half yet, you can pull money out tax-free and no penalty, unlike a qualified account. And there's no RMDs at age 73 that you have to deal with and pay tax to the government. And you have a guarantee against losses. There's no other product can do that. Every other product out there, I say is kind of a one-trick pony, so to speak. They'll do one thing, like take a stock. Okay, you can make money in a stock, but also does one other thing. You can lose money in a stock, but you don't have all these benefits. Now, I'm not knocking stocks. I'm just saying that the IUL product, hands down, the right person at the right time and designed properly, is hands down an awesome product to put in your portfolio to diversify.
Yeah. Speaking of the stocks, that's another. Thanks for bringing that up, because I kind of want to share again a little bit about the stock piece. So for stocks, because there you aren't saying get rid of your stocks completely, but let's just say that someone has money in the stocks, right, in some way, shape, or form, and they love having their money there. Obviously, let's say that wow, okay, I'll do this. There we go. Okay.
That's a straighter line.
Yeah. Okay. I'm having a tough time here. Okay. We got this. So let's say that you've got your money in a stock market and it's having these years, right? Not realistic, but realistic. And you've got these specific moments where, where's blue? Right. You have these specific moments where your money's down, right? Obviously, in these years, you don't want to, like, it sucks for you. Obviously, people much prefer these years, right? And this is why people love the market so much, because you have these crazy awesome returns. But now, obviously, this is great for while you are, let's say, growing 25 to 65. And this is what a lot of people think of, right? Whether it's 65 to 25. But what about after? Right? What about
Yeah,
when
the
you are in
accumulation
retirement?
phase when you're growing
Exactly.
your money for retirement is a lot different. Is totally different than when you're withdrawing.
Yep. So withdrawal or retirement. Now, here's the thing that I think a lot of people miss out on whenever they're dealing with the stock market, especially if they aggressively love the stock market. Like you said, you're not saying like take all your money out of the stock market, but think about this, right? If this is during your retirement ages and you're having these negative years, if you're taking money out, like you said, if you're taking out 4%, you've lost a lot of money here. You lost a lot of money here, and you still need to take out money for your retirement. And that's crazy because you've already lost so much money and you're going to lose more money by pulling money out.
You're definitely going to
It's,
shorten the length of if your retirement was going to last you 30 years and you have these losses and you're pulling out during the down cycles when the losses, you could significantly shorten the years that your retirement will last.
yeah. And I think that while doing this, I think it's important to understand that, well, if you know for sure that you always have something like your indexing strategy that you just showed, where you know you're never going to take guaranteed losses, right? Even if it's growing like this, right? Maybe the highs are not as high, right? But I think it's important to realize that in this down year right here, let's say this is 2050, instead of taking money from here, you can leave your money there, keep that money fine, and in 2050 over here, you just take money from your indexing strategy, from your IUL instead. And
Great
that allows
strategy.
you to keep it much longer, right?
100%.
Yeah. These years that you're down, this is why it's like perfect. Even if you love the stock market and you've done really great, there's going to be down years. And so if you know that you have a nice little cushion down here, smiley face, you have a nice little cushion down here, that at that point you can take tax-free loans from your indexing strategy instead of from the stock market. That's ultimately going to would put you in an even worse situation, because it will happen, right? Like you've got 65 to 100 plus, right, or whatever the case is. You're going to have negative years. In those negative years, you definitely don't want to pull money out, especially anyone that has money in the stock market and it actively or aggressively funds their accounts that way. They know that there's going to be negative years. Just don't let those negative years be a year where you also need to take out from here. And it's much better to be able to have a cushion where for sure that you can be able to do this. Plus, I don't know, cool thing for me is if I'm having these great years, I'm taking some of that money and putting it over here. That's what I'm doing. But that's just a little bit more, obviously, like people like to have much more money in their stock accounts as well. But I mean,
100% agree.
yeah, I think that is probably one of the other little cool pieces is that like you said, maybe it's not this or that. It's a matter of diversifying it. And now as you're doing that, you're also paying taxes on that stuff. Some people don't care. Yeah. Well, Gerard, thank you for being able to share it with our community, because I think this is definitely one key piece to the blueprint to your individual financial success. And so definitely appreciate you sharing your wisdom and knowledge with us. And for everyone else, hopefully you got the chance to have a little bit of this financial blueprint that you can take with you. Definitely be sure to reach out to me. I can get you guys a hold of Gerard on this retirement planning strategy as well. But Gerard's like LinkedIn and contact information will also be in the description below as well. And if you're listening from Spotify, howdy, howdy, and also his information will be over on YouTube as well, So, Gerard, thank you for today.
It's a pleasure to be on here, and good to see you, Charlie.
Yes, you too. So with that, guys, have an amazing day. Tomorrow we've got tomorrow. What is on the list for tomorrow? Tomorrow we've got types of ways to enhance your business, especially if you're a business owner who does anything in the realm of working with other individuals and prospecting, how to be able to accurately talk and build good, genuine relationships with people, to be able to work with them and build them up. So I'm excited for the rest of this week, but you guys have a beautiful day. Go and do great things today, and I shall see you guys tomorrow morning. See you guys.
Take care.